I'm Olivia Voznenko.
I'm Steve Guilfoyle. You're watching Street Smarts.
With a special guest.
Good afternoon, sports fans. Today, we have a very special guest for you here on Street Smarts. We have Danielle DiMartino Booth, the CEO of Quill Intelligence and the author of the best-selling book, Fed Up. Welcome, Danielle.
So happy to be here.
Well, Danielle, we had the FOMC decision yesterday. That's your specialty. That's what you focus on. That's what you're known for.
No.
Yes.
Former Fed insider.
Yeah, well, my specialty is equities, and we saw the algos take advantage of the omission of the word accommodation yesterday, run the stocks down, pick off little people, then run them back up today. It's a story told 1,000 times over. But you, as really a professional economist, whether you call yourself that or not, I have been an economist, and I consider you an economist, a better one than I. What is your take on the omission of that word?
It was interesting. In late May, in a speech he made in Stockholm, Jerome Powell said basically that forward guidance, which is what accommodative was forward guidance for the Fed. Every other central bank has their own form. He said that was an appropriate tool to have in place during times of crises, which we're not in. So he advertised back in late May what he was going to do yesterday, and he did it. So he said, if you keep a tool in the toolbox that is used as a signaling device and you don't put it back in the toolbox, then it loses its ability to signal. And that's exactly what forward guidance had lost, because people had become habituated to the Fed's going to be lower for longer for approximately ever.
You kind of like him as a leader, don't you?
Oh, I like Jay Powell.
It comes across.
I do. I like Jay Powell. Look, I'm not the founder of the Jay Powell fan club. I'm not. I think that the choice of John Williams at the New York Fed is questionable. And this is somebody who said that I've never had a Bloomberg terminal on my desk.
I agree with you.
Publicly. So I'm sorry, but he's running the New York Fed. He's regulating the financial system of the United States. And Jay Powell was definitely right behind his coming into that position. So I don't agree with everything that he's done, but he is plain spoken. He is truly data dependent. And his three predecessors, Greenspan, Bernanke, Yellen, they said that they were data dependent, but they weren't. No, they had models upon which they were operating and making monetary policy that had absolutely nothing to do with the actual data. Jay Powell they're asking about 2021, and he's like, what do I know? I can't tell you about 2020. And he's he's out there. He's not an economist. I love him.
So why are bank stocks selling off? No more Fed hugs?
It was interesting to see in the aftermath the narrowing of the yield curve. So we actually went down to 21 basis points between the 2-year and the 10-year Treasury yield after the Fed meeting, and I found that to be interesting. And we've seen a weakening in the dollar as well, and which is fairly unusual because we've seen the benchmark 10-year yield cross over that 3% psychological threshold, which should have dictated that the dollar followed it and took down God knows what country in the process, right? Because that's what happens every time the dollar strengthens and we've got a 10-year over 3%, is that Turkey, Argentina, the Philippines, some country goes. That has not happened, and we have to wonder if the financial markets are not starting to get anxious about the size of the deficit.
Do you think that means, is that a vote against inflation or growth?
Well, it was, in the press conference, it was interesting to listen to Powell's answer when he was queried about the tariffs. And there's the yin and the yang. There are everyday low prices at Walmart that are going to be going up. That's bad for consumption. That's bad for consumers. Because that's the kind of inflation that you do not want, and that would theoretically put the Fed into the opposite of a tightening pattern. They would start reducing interest rates. But then on the other hand, there's the follow through to inflation because of the tariffs that would put the Fed on a more aggressive tightening path, which is why my nebulous bad answer right now is the same as Jay Powell's was yesterday. And he said it's to be determined who actually is more damaged by trades and tariffs, U.S. consumers or runaway inflation. So, and it's all contingent upon whether he tightens more or less.
I'm going to steal this out of Steven's mouth. I know you're going to ask
Go
it.
ahead.
the inversion of the yield curve. I know he's not. I know he's like, okay, like why am I focused on the future?
Sure.
But that has to be in the back of his mind, no?
He is a 20-year veteran of Wall Street, which we have not had. He's not a PhD in economics. He knows on a pragmatic level that every single time that the yield curve is inverted, that fear has ripped through Wall Street, and that's all it is. The inversion of the yield curve it's not necessarily a definitive signal about where the economy is, but it does strike fear into investors' hearts. And that is a turning point when markets have been as crazy as they've been. So Jay Powell understands good and well what the implications are, and given that I like to think that he reads most of what I write, he will probably know after what I published yesterday that the inflation-adjusted yield curve, the real yield curve has already inverted. And that always precedes the inversion of the nominal yield curve, which is what we all pay attention to. So to Bernanke's credit, did I just say that? He gave a speech in 2013 that explained that once the inflation-adjusted yield curve inverts, watch out because the nominal's right behind it. So yes, it's on Jay Powell's radar.
Does that make Lael Brainerd something of an idiot? I mean, you can't say that. I can say that because I'm a little rough and tumble, but does that make her wrong?
The yield curve matters, but to Lael Brainerd's credit, yes, I just said that. And Charlie Evans and all of the former doves, they have all, the thing about Powell is we hear so little from him, yet he has brought his troops in line. He has made the doves wax hawkish, and you hear her saying that she thinks that the neutral rate should be 3%, and you're like, are you sure you're the woman who contributed to Hillary Clinton's campaign publicly because you were going to be Treasury Secretary?
Well, she gets accused of politics on this.
Of course she does, but and rightly so, because she publicly gave to a politician, which is a no-no. As a former Fed insider, I can tell you that politics have no place in central banking, or they shouldn't. And she crossed that line, and yet Jay Powell has managed to bring her into his way of thinking such that she sounds like a hawk. It's a miracle.
Her and John Williams both.
And Charlie Evans, who's the Uber dove from
Chicago.
Chicago.
You know who's sounding sensible these days? And I used to think he was a quack, Bullard.
Bullard.
Oh my
I have
gosh.
written about Bullard.
Holy cow.
I have written extensively about Bullard because Bullard and Jay Powell both said, 1 week apart, Jay Powell said it at Jackson Hole. Everybody was just so excited because the economy wasn't overheating. And the minute the reporters heard him say that, they did not listen to the rest of his speech in Jackson Hole. In the final 3 paragraphs of his speech, he basically said, from the perspective of a central banker, inflation is a broken metric. It did not flag the oncoming recession prior to the 2 last downturns. He said these are his words. And therefore, we shouldn't be following inflation. We should be following the financial markets to find out where we are in the cycle. A week later, Mr. Bullard says the same thing. The dove, the lonesome dove. If you see any sell-side brokerage, Merrill Lynch, if you see any of them put all the members of the Federal Open Market Committee on a spectrum, he's way over here in the dovish. And yet he said, inflation didn't flag the last 2 downturns. We must pay attention to the financial markets. And I'm like, Bullard.
Yeah, I told Olivia the other day, I said, I don't believe this, but I'm almost sorry I wrote all those nasty articles about Bullard years ago.
Well,
I'm liking me some Jim, and Jim is also the person who, I'm not trying to sell a book, but the most fascinating aspect of Jim Bullard is that he is the crap in, crap out man. And once, Stanley Fishers, who was the former vice chairman of the Fed, when he first joined his very first FOMC meeting, he said, I use the CPI, my children use the CPI, the rest of the world uses the CPI. Why do we use the core PCE?
Which comes out tomorrow.
And to which some, very brave Fed staffer raised their hand and said, well, our models wouldn't work if we didn't use the core PCE, to which Bullard replied, let me get this straight. The way that we make monetary policy is such that it is crap in, crap out. And that was Bullard.
He was spot on.
In 2014.
Look at that.
So I have newfound respect for him.
Wow. So Jerome Powell has whipped the Fed into shape.
He says he says less than anybody. There's no speeches. He does not need the validation of the media. Clearly, I do. Kidding. But he says less than any of his predecessors. The Fed statement was 250 words.
I saw that
yesterday. I mean, he has just.
No
I'm going to
us
say
anymore.
it, get to the bottom line, move on. The very first line of his statement for his press conference consisted of a four-word sentence. This economy is strong. And you're like, somebody give me my oxygen, because he's so plain spoken.
Yes, he is.
It's so refreshing.
He's very clear. He's
the
very
last two
easy to
Fed
listen to.
statements are the first two Fed statements ever that I did not have to downsize the font in order to print it out. Full size,
And no
one
fillers.
page.
No, remember the Sorry, Janet, just saying.
Well, you brought up inflation, and you've been writing lately a lot on rising input costs, which your writings, you and I often think about things the same way, although you're a
margins,
little more eloquent.
margins.
And you rattled my cage a little with some of this writing, and I hope the rest of the equity traders are paying attention. Do you think, I see the potential for a recession within 2 years. Are you along these lines with me, or are you somewhere else?
You know, it's interesting. I ran into Scott Minerd last night at my post-FOMC debrief dinner, and he's come out publicly and said this, and I'm of the same opinion, that if your big brokerage sell-side firms are publicly stating that they anticipate that recession could arrive in 2020, that means that they're budgeting for 2019 internally. It is the way Wall Street works, because that's where I started. And their equity strategists are always going to talk their book, always. But if you look at the episode that followed the yield curve inversion of 1999, as opposed to 2005, the yield curve inversion in 1999, we were in recession within 13 months because risky assets were more overvalued at the time. So we had a shorter runway between the point of inversion and heading into recession. And I think we're in a similar economic backdrop today, and we don't have that 24 months that we had when the yield curve last inverted in 2005.
And things happen faster now.
That's my point.
No doubt about it. The electronic age, the algorithmic age, it's
Oh,
not a
yeah.
guy like me sitting in his office going like this anymore. It's
Right. Let me pull out my discounted cash flow and let me study my spreadsheet for the next week.
So let me highlight this. Are we dovish, hawkish? Where are we right now?
Where is Danielle?
Yeah, I'm curious.
Because I'm a little dovish for the first time in my life.
I think
That's a first.
I think that the yield curve flattening in the face of a fairly hawkish Fed is signaling that the economy can only handle so many more rate hikes. And as much as Jay Powell would like to get from where we are today, 2 to 2.25% Fed funds to 3%, he really wants to get to 3%. I just don't know that we get there without being in recession.
So what do you think about President Trump being all control freak on the Fed?
Well, I think he should put his opinions elsewhere. It's an apolitical institution. It's run by a non-academic for the first time in over 30 years, and I think he should keep his opinions quiet about the Fed.
I'm not going to criticize or
I'm not being
or
critical.
compliment
I'm
the
not being critical
president.
of Trump. I'm
No,
I'm
but
simply
I-
stating what the law is, and
I
that
don't
is that the
think
Fed
he
is an
has that
apolitical
inner voice.
institution.
I don't think that's going to happen.
Look,
Yeah.
Jay Powell
He's not affected by it.
Jay Powell is somebody who worked for $1 salary to educate Congress on the perils of the United States defaulting on its debt. He does not need the Fed's pension. He doesn't need to be there. He's there to serve his country. He has no agenda. And if he doesn't have an agenda and he's just there to do good for the people, then it won't matter what the president says. He's going to keep doing the good.
I know you took a look at the dot plot. I know you look at the median projections and all that nonsense. Now,
Nonsense. That's a word
well, it's
that
true.
we should attach to the
That's
dot
what
plot.
it is.
It's called spot the
What
dot.
I love, and I'd love to get your take on this, is I watched the GDP dwindle from 3.1% down to 1.8% on their median projections. I watch a flat line for inflation, a flat line for unemployment, yet they think in that environment,
3.7% unemployment rate, which is like gangbusters
which is
as far
awesome.
as the eye can
We're going to
see.
hold that for 4 years.
Exactly.
And with no inflation.
And I just, look,
dwindling
there's a
GDP.
unicorn. Okay.
But they think they're going to
It's on a rainbow.
They think they're going to jack the Fed funds rate all the way from where it is. The one guy had it at 4.1% on the end.
Yeah, he went rogue.
Who's this guy?
God bless him.
I mean, maybe maybe the more able members of the FOMC could like help the weaklings out here. Maybe you really don't know how to interpret data. We'll send you a couple of guys to school you up. I mean, that's awful.
Look,
that's an awful misunderstanding of conditions.
You do sports. Can we call time here? Let's call time. He got rid of press conferences after only 4 meetings. Step 1. He got rid of forward guidance, placating, coddling the market, holding investors' hands. He got rid of that yesterday. In his press conference, he said that the dot plot was interesting.
Good.
And that it was something that the media liked to talk about, which means, in his view, it's nonsense. So can we just maybe have step 3 be getting rid of the dot plot? Jay, can you hear me?
I hope he's, Jay, can you hear her?
We'll tweet him out.
But by virtue of the fact that he said that the dot plot was interesting means that he finds it to be useless. He's like, it's a bunch of individuals' views, but it's not what the committee does.
It clearly is if they think, if their group think is that as GDP is halved, that unemployment will remain stable.
Which means they're delusional.
It means they don't understand economics. These are economists.
If there's one thing that was ironic for me after spending nearly a decade inside the Fed, it's that economists, textbook academic economists, know that unemployment is the most lagging of all economic indicators. So, ergo, if you follow the unemployment rate in making monetary policy, you're way behind. You're the caboose. You need to look at leading indicators. And the only thing that concerns me about Powell is that he's not paying close enough attention. He spoke to the corporate bond market, but I don't think he's paying close enough attention to some of the signals that are emanating from the riskier portions of the bond market right now, which are, by the way, bigger than what subprime mortgages were back in 06.
That's some spooky stuff that's imminent.
There's some spooky stuff.
It is.
Speaking of spooky, you have something to say there?
It's
Well,
almost,
of course
it's almost
I have something to
October.
say.
It's almost.
I know exactly.
Then ladies first.
Well,
'Cause I've been hogging this up.
oh, it's okay. You economists. So, in terms of how the market's going, do you see anything crazy going on in the next few months, year end, maybe into 2019 when this stuff is apparently going wild?
So what's interesting to me is that people find there to be some kind of a mystery in why the United States is outperforming the rest of the world. You've seen the charts. They put them out there. It looks like this yawning gap between the United States S&P 500 and the rest of the world, which is falling off a cliff. Well, guess what? We had a tax cut. And you don't have $2.1 trillion of quantitative easing evaporate as of, Monday, because October the 1st is when we hit our most extreme run rate for quantitative tightening here in the United States, $50 billion a month, and the European Central Bank halves its tapering from $30 billion to $15 billion in purchases a month. So we're at the most extreme in terms of the tightening cycle as of October the 1st. So why hasn't the stock market reacted? Well, we had a tax cut. So we'll have $850 billion of share buybacks in 2018. Nobody needs to sit and ruminate and why are U.S. stocks doing so much better? There's no mystery. Liquidity is agnostic, whether it's in the form of central banks printing money or in the form of corporations buying back their stock. Liquidity is liquidity, and it is going to float the market until it doesn't.
Yep.
I knew there was a day until it doesn't coming. So basically we have QE got us this far. Now we have fiscal policy that took us this far.
QE got us through 2017.
Now we have
fiscal policy is getting us through
we
2018.
have robust earnings growth of poor quality,
Thank you.
you might say.
You're the
That-
stock jock. You do that gauge.
Well,
Gotta be
that only
proud.
take us so far, and when that sputters, then all of a sudden
Dot.
that's when your unemployment will start.
Yeah,
to
that's
rise.
the real dot plot, the dot.
And that'll be when the yield curve
And
doesn't
actually,
break.
there's something very mechanistic and mathematical about when layoffs will start to hit, because we've had, we've had a record run in the history of the United States of mergers and acquisitions. We've had a lot of merger Mondays, and that's all great until the aftermath of the Bain consultants who are like, we're going to extract synergies after we marry these two firms, and that's a very polite way of saying layoffs. And if you look at the Challenger Grain Christmas data that come out every month, we have seen layoffs attributable to M&A activity spike to a 2-year high. And we're just now at the very beginning of the layoffs attributable to M&A. And so we think we're at the peak of the cycle, and that this will, and this is absent Wells Fargo laying off 26,000 some odd employees, and Starbucks doing, downsizing, firms you wouldn't think of. That's in addition to all that.
Oh, I just see empty streets, horrible music. It sounds pretty spooky.
The sun is shining, though.
The sun is shining, but I will tell you, I in my portfolio, I have decided to use the usually rising prices of November and December into early January as a chance to raise cash.
I think that's very, very prudent.
That's what I'll be doing, and maybe buy a little gold.
That's crazy to hear that.
Well, that's what I do. Cash is a position, and
Cash
you
is
have to
king.
manage it.
30 days, you get over 2%.
So Danielle, do you recommend any kind of safe havens? Any kind of safety plays?
It's interesting. I've written extensively on the public pension system and the fact that the state of Illinois is going to have a mushroom cloud over it, et cetera, et cetera. But that being said, to totally contradict myself, I actually own quite a few individual municipal bonds in my personal portfolio, because there are so many states and municipalities that have been more conservative in their approach, and they're not underfunded, and they're a great way to get a leg up on what you can get with a taxable piece of fixed income. So,
for instance, what states?
Well, actually, the state of New York has a very funded pension. The police, firemen, unions, cities, not so much. But there are certain states that, thank heaven, somebody else does the foraging for me and looks for the truffles in the forest. But there are certain states that are in very good shape that will come out of this. And every time you throw the baby out with the bathwater and you take the whole asset class down, you have another buying opportunity.
Meredith Whitney wasn't really wrong.
She wasn't wrong, she was early.
That is a juicy tidbit. And guys, if you want to get more of Danielle, of course you do, be lucky enough to subscribe to her Daily Feather. It is an excellent read.
And a first retail product is $25 a month. The IRR is off the charts.
I look at it
insane.
every day, gang.
And it's
Why do you
so
think I'm
easy to
so
read.
smart? Not because I'm so smart.
Clearly. That's how we prepare for our interviews. Anyway, Danielle, thank you so much for coming on
Great
the show.
to be here.
Go New York, and we hope
Go
to
Yankees.
see you. Yeah, there you go, the Yankee bonds. And we hope to see you soon, please.
Safe travels.
Absolutely. Thank you.